Assalamu alaikum. In this video, we will discuss about what is loan, how does it works, types and tips on getting one. First of all, we will discuss what is loan. The term loan refers to a type of credit vehicle in which a sum of money is lent to another party in exchange for future repayment of the value or principal amount. In many cases, the lender also add interest or financial charges to the principal value, which the borrower must repay in condition to the principal balance. Loan may be for a specific one-time amount, or they may be available as an open-ended line of credit up to a specified limit. Loans come in many different forms, including secured, unsecured, commercial, and personal loans. Key takeaways: a loan is when money is given to the another party in exchange for repayment of the loan principal amount plus interest. Lenders will consider a prospective borrower's income, credit score, and debt level before deciding to offer them a loan. A loan may be secured by collateral such as mortgage, or it may be unsecured such as credit card. Revolving loans or lines can be spent, repaid, and spent again, while term loans are fixed rate, fixed payments loans. Lenders may charge higher interest. Refer to risk borrower understanding loans. A loan is a form of debt incurred by an individual or another entity. The lender, usually a corporation, financial institution, or government, advances a sum of money to the borrower. In return, the borrower agrees to a certain set of terms, including any financial charges, interest, repayment date, and other conditions. In some cases, the lender may require collateral to secure the loan and ensure repayment. Loans may also take the form of bonds and certificates of debits deposit. It is also possible to take a loan from 401k account. The loans process. Here's how the loan process works. When someone needs money, they apply for a loan from a bank, corporation, government, or other entity. The borrower may be required to provide specific details such as the reason for the loan, their financial history, social security number, and other information. The lender reviews this information as well as person debit to income ratio to determine if the loan can be paid back. Based on the application's credit worthiness, the lender either denies or approves as the application. The lender must provide a reason should be the loan applicable application be denied. If the application is approved, both parties sign a contract that outlines the details of the agreements. The lender advances the proceeds of the loan, after which the borrower must repay the amount, including any additional charges such as interest. The term of a loan are agreed to by each party before and money or property changes hands or disbursed. If the lender requires collateral, the lender outline this is the loan document. Most loans also have provisions regarding the maximum amount of interest, in addition to the other covenants such as the length of time before repayment is required. What are loans used? Loans are advanced for a number of reasons, including major purchases, investment, renovations, debt consolidations, and business ventures. Loans also help existing companies expand their operations. Loans also for growth in the overall money supply in an economy and open up competitions by lending to new businesses. The interest and fees from loan are primary source of revenue for many bank as well as some retailers through the use of credit facilities and credit cards. Components of loans. There are several important terms that determine the size of a loan and how quickly the borrower can pay it back. Principal. This is the original amount of money that is being borrowed. Loan term. The amount of time that the borrower has to repay the loan. Interest rate, the rate at which the amount of money owed increases, usually expressed in terms of annual percentage rate APR. Loan payments, the amount of money that must be paid every month or week in order to satisfy the term of the loan based on the principal, loan term, and interest rate. This can be determined from an amortizations table. Tips on getting loan. Income. For large loans, lenders may require a certain income threshold, thereby ensuring that the borrower will have no trouble making payments. They may also require several years of stable employment, especially in the case of home mortgage. Credit score. A credit score is a numerical representation of a person's creditworthiness based on their history of borrowing and repayment. Missed payments and bankruptcies can cause serious damage to a person's credit score. Debt to income ratio. In addition to one's income, let us also check the borrower credit history to check how many active loans they have at the same time. A high level of debt indicates that the borrower may have difficulty repaying their debts. In order to increase the chances of qualifying for a loan, it is important to demonstrate that you can use debit responsibility, pay off your loans and credit cards promptly, and avoid taking on any unnecessary debt. This will also qualify you for lower interest rates.